Hello. Good evening, everyone. Mic check. 1 2 1 2. Welcome. First and foremost, can everybody see me and hear me? If you could leave me a little message in the chat just to let me know, that would be great before I keep moving on into the event. I'll have to wait a few seconds because there's a little bit of a delay between me speaking and you hearing me on the other side. I'm hoping. There we go. Perfect, Dan. Thank you very much. Yes, Connor, Joe, loving it. Brilliant. Well, look, everyone, welcome to this evening's event, my first Investing for Beginners class, and you're all very welcome here this evening. Brilliant. I can see more chat messages coming in there. Thank you, Ali and Denver, too. Well, I appreciate you all being here this evening, and I do look forward to sharing some investing knowledge with you over the next hour and 40 minutes or so. I will do my best to make this as interactive as possible. So if you want to reply to any questions that I ask, you can subscribe to the channel and you can do so in the chat. That would be awesome. And I think you have to do that at the bottom of the screen, but that's absolutely no problem. Stick around to the very end and I'll be doing a Q&A. I'll answer as many personal finances questions or investing questions as I can live. And just to let you know, as I said, there's about a 10-second delay between me speaking and you hearing what I have to say or responding. So if you could hold your questions to the end, that would be great, because by the time you ask a question, I'll be 10 seconds ahead and it'll just mess up my flow, to be honest. But during the Q&A, I will slow right down and we'll wait for the questions to come through at that time. If you're happy to do so, please live tweet, post on the gram, or share messages on LinkedIn using the hashtag Foundered. I'd really appreciate it. So before we get started this evening, where is everybody from? And I can tell you, I know from the chat, my next door neighbor's on, so thanks very much, Ali and Greg. I'll have to wait a second now. Do you guys hear me or see? This is the longest 10 seconds of my life. Okay, brilliant. Thank goodness that started to come through. We've got Denver and Armagh, Daniel in Belfast, Dan in Hearts over in England, Jared, welcome Jared, from Lisburn, Joe and the Michael Edwards, two bros, friends of mine from Belfast. Well, look, you're all very, very welcome. Thank you all for joining me this evening. What I'm going to do now is I'm going to move into the presentation mode so that you can start to really see the conversation from the presentation, and then we'll take it from there. So give me one little second. Boom, nice and easy. Once again, everyone, look, you're all very, very welcome. My goal for this evening is to give you the knowledge and the understanding to make your own investment decisions and ultimately give you the confidence to do so. It's investing at its heart it's really easy, and I'm going to explain why. But first things first, we've got a lot to cover and I'm going to talk about a plan for this evening. First, I'm going to tell you a little bit about my background and my own money story. Some of you may know me from my previous business. Others may know me from the Foundered social channels and have been following me for just a little while. But in case you're new here, I'll give you a brief history about my relationship with money and where I am today. Then we're going to talk about money anxiety and how to reduce it. A lot of people that I talk to worry about money, and this fear is something we need to tackle before we start investing, and we'll cover that in depth. And once we tackle money anxiety and we tackle it head on, it's time to make a plan for our money as well. And it doesn't matter if you earn a little or you earn a lot. Knowing exactly where your money is going is critical to any successful financial plan. So we'll have a look at that. And after all of that, I'll explain why saving isn't enough and you do need to invest to build wealth. We're going to talk about how to make, we need a fast saving versus investing. And we're going to talk about making your money work for you, even when you're sleeping. And if that's your goal, please give me a big thumbs up in the chat as well. And every one of you needs to develop an investing mindset. But what is that? And I'll cover that a little bit as well. Next, I'm going to look at the main topic of today, which is investing. And this covers quite a few areas. So we're going to delve into index funds and what to invest in, investing strategies and what to invest in, index funds, how to invest here in the UK. And I'll also walk you through buying your first and choosing your first investments with Vanguard. And we do then need to chat about fees and why they matter. And for those of you who stick to the very end, I'll share some details about my upcoming budgeting course, and then we'll get live into the Q&A, which I'm really looking forward to and very scared about. Does that sound good to everybody? Awesome. Great. So let's talk about my background. And firstly, a big welcome to everybody who's known me for some time. I've noticed some past clients in here and a few friends in the signups, and actually some family members as well. So I'm going to take that as a big vote of confidence. You're all welcome, and thank you for joining. You guys have a good idea of who I am, so please bear with me. But for those who don't already know me, well, my name is Connor, and I am an early retiree who retired last December at the old age of 40. Prior to retiring, I started a printing and a branding agency in 2009 called Kaizen. In fact, it was in this very room on the 21st of September 2009, right in the middle of the financial crisis. Fast forward to, 2022, Kaizen was a over £2 million business with a team of over 40. In 2020, Kaizen was acquired, and in December 2022, I exited the business. Whoop! And well, somebody recently asked me if the reason why I was able to retire was because I sold my business. And the answer was yes, but it was also no. Because prior to Kaizen, the largest salary that I ever earned was £20,000 per year. Retiring at 40 would have been impossible to do so on that salary. So yes, the business did allow this, but on the other hand, I would have been able to retire without selling the business. Selling it allowed me to do so with a little bit more comfort, with a cherry on top. And I think it's important to note that while it doesn't matter what your income is, because the principles that allowed me to retire early are the same for everybody, no matter what your goals are. Yes, entrepreneurship is definitely the catalyst that got me to my goals, that allowed me to achieve my goals, but I am a huge fan of people building their wealth this way as well. And that's, most people who know me know I talk about business a lot. Yet the core elements of earning more, spending less, and investing as much as you can are applicable to anyone, no matter what your financial goals. And I'll explain that later. Growing up, we were not told an awful lot about money. One rule that stuck with me in my household and my brothers in our household is that you don't spend money that you don't have. Credit was a dirty word. And outside of a mortgage, if you didn't have the cash in your pocket to buy things, you just didn't buy them. And to be honest, this is the lesson, the one main lesson, and the reason why our business was successful and why I have never taken on any personal debt. I first then started planning for my retirement in 2013, and I was 31 years old. And like many 30-year-olds back then, even now, I imagine, I'd not given any consideration to retirement. A pension was for old people. And other than trying to pay off our mortgage quickly, I had no plans for my money. However, starting a business had done quite good things for my salary, and I had taken home a multiple of what I was earning as an employee. Instead of letting my lifestyle naturally inflate to my new income, I thought and had the thought that I wanted to make this money work for me. But at that point, I had absolutely zero knowledge about investing, and my idea about saving was a Henry Hippo who was sitting on my childhood desk. That was literally it. We aren't taught about money in school, and to be honest, I think that's criminal, because we all need to understand money better, to be honest. And the good news is that right this second, there's a ton of information out there, and everything that I'm discussing tonight can be easily learned because I learned it myself. And I've spent the last 14 years understanding money a little bit better and trying to find the most efficient ways to, well, I've said it twice now already, but earn more, save more, and invest as much as you can. Sorry, so just seeing the chat there, Scott, you're very welcome as well. It wasn't easy to do that, but I can tell you right now, as somebody who's retired just shy of a year, it was totally worth it. So it's in my opinion, it's not your fault that you weren't taught about your money, and it isn't your parents' fault either. But I'd say that right this second, It's your responsibility to learn it. So tonight is not going to be all about me. That's the last thing that I want. But I do want to explain a little bit about how I was able to retire early and how ultimately this can benefit you. Retiring at 40 is, look, I am retired. It says it on my t-shirt. Retiring at 40 is pretty uncommon, to be completely honest, unless you inherit a fortune, which I didn't. The only way to achieve this is to heavily focus on money. For nearly 10 years, from 2013 to 2023, I followed the principles of the FIRE movement, which is financial independence, retire early, if you haven't heard of that before. The FI element of FIRE happens when your income generating assets, such as investments or rental properties, meet your living expenses. And the retire early, or the RE part, gives you the freedom on whether or not you want to continue working. Money is not the reason to continue working. And if you think about it, most of us think about retirement as an age, the age at which you get your pension, whether that's 58 for your private pension or 68 for your state pension. But if we flip that on its head, financial independence and retiring early is a maths question. It's a financial calculation. You can retire not when you reach a certain age, but when you can afford it. And there are three main pillars to financial independence. I've said them 3 times at this point, and they are spend less, earn more, and invest as much as you can. And no matter what your financial goals are, or when you plan to retire, everything you'll ever hear me say boils down to these 3 areas. And tonight, we're talking about investing in the stock market, but the other 2 are equally important. And in the coming months, I hope to hold a few more events just like this. So please let me know in the comments if there are any topics that you'd like me to cover as well. I have 3 pints of orange juice beside me because I was hoarse this morning. Excuse me. Excellent. So my future, I told you it wasn't all about me, but there's 1 more, 2 more slides here. I launched the Founder brand. I'm hoping some of you might know of it. And since December of last year, I have written hundreds of articles, thousands of hours of social posts, and hundreds of videos that I post here on YouTube quite regularly, but not over the summer. For me, Foundered helps people to understand money just a little bit better, and it's my retirement project. It gives me a purpose every single day and the opportunity to connect with people right across the world. I see Joseph from America here. He's a friend of mine I met in the personal finance space, and next week I'm speaking with a lady from New Zealand, because this gives me something that I can speak to people confidently about in a time where, you can sit and drink pina coladas on the beach, but that's not me. And ultimately, Foundered is the information and the education that I wish I had access to when I was first starting out. Nothing more and nothing less. And well, since December, my videos have been viewed over 185,000 times. That's mental. And my articles have been read over 100,000 times. I've been featured in Belfast Live, commented on The Guardian, and I've been on local and national podcasts, which I'm incredibly proud of. And to be completely honest with you, this is really just the start of it, because if those who know me already know that I'm pretty driven when it comes to, well, I'm just pretty driven, and that's my nature. I think it was bred into us, which I'm very happy about. Yet, I've been a marketer all my life, and I had to add this slide just this afternoon, because you'd think that somebody who knows what they're doing when it comes to, well, thinks they know what they're doing when it comes to marketing, they would have all their bases covered, but that's not always the case. I posted about this event yesterday on LinkedIn, and Pat, who I can see on the chat already as well, thanks again, Pat, for joining me. He commented that he didn't know that I posted videos, and that shocked me, because videos are a huge part of the content that I create. So to make sure people know where to find my bits and pieces, there are 3 main places that you'll find me online. YouTube, you're already here, and you'll find all my long form content videos. Instagram, you'll see my username is Connor Foundered, Connor with 2 N's, Foundered, all one word. And I post quick money tips and business advice and a lot of lighthearted content over there. And the main place that you'll find all things about me is the website foundered.co.uk. There's a huge mixture of videos and blog content and some social posts mixed in, and what I tried to do there is cover 4 main areas: saving money, making money, I nearly forgot there, investing, and retiring early. Now, those are very, very broad topics, and this project isn't something that I can complete in a day or a week or even 10 years. So I will continue to do that as often as possible. So always check back because there's frequent content, a couple of articles and videos every single week. So before I go on, I have a little request. And those of you who have worked with me in business know that I always ask for recommendations and referrals. So if you find my content useful or indeed any way helpful, I would please ask you that you share it with somebody else. And that's it. That's the pitch for tonight. Right. You're probably asking yourself why you should listen to me. And that's a great question. Make no mistake, I am not a financial advisor and I will never tell you how to invest your money. I'm not qualified nor legally allowed to do so. I have to make that very clear. In fact, none of what I say tonight from a legal standpoint can be considered financial advice, as I do not know your own personal situation and I am not qualified to offer specific or tailored advice. That is very important that I do clear that up straight away. However, everything I say is educational in nature and it is intended to provide you with enough information and direction to make your own informed decisions. At the very least, it's a starting point for further learning. And don't follow what I or anybody like me says blindly, because nobody has all the answers, and everything that I say at this event, online, and any of my content is my own experience only. So make sure that you get a broad depth of knowledge from different people, because sometimes I get it wrong too. And while I am sound, that's absolutely no reason to listen to me blindly, because this event will help you to understand how to invest, how you can decide which type of investments you make, and how to make your own investments. However, if after that you're not confident in doing it alone, there are tons of financial advisors here in Northern Ireland, across the UK and worldwide, who will be able and very willing to help you. And in fact, I know a couple of those guys who are financial advisors are in the chat already as well, and you're all very welcome as well. Right, I promise when it comes down to it, investing is really easy. I mean that. All you're going to need is an internet connection and £100. But when you're starting out with limited knowledge, you can make mistakes, and these mistakes cost you money. When it comes to investing, I have made all the mistakes possible. I've bought the wrong investments, I've bought the wrong accounts, and I've tried to time the markets. And I promise you that it's easier for you, and well, really cheaper, a lot cheaper, to learn from me and my mistakes than from your own. So tonight is an educational event. But if I held it on a Thursday night with a glass of wine in my hands, we'd call it a party. World's worst party, nonetheless, but a party. So expect a little bit of crack, absolutely zero fluff from me, and a ton of good investing knowledge and information shared over the next hour and a half. Right, take a wee drink, read the messages. Okay, brilliant, thanks everybody. Class. Now, money is a taboo subject. People are often afraid of money. They're often worried about talking about money. And when I post anything on LinkedIn, on YouTube, I'll get 10 times more people messaging me privately than those people who will comment. Because people are often embarrassed about their situation, or indeed on the other side, they don't want to brag about their wealth. And I understand this from both perspectives. And tonight is a money positive event. We're going to talk about money freely, the good and the bad. So without stigma or fear of what people think, please put a virtual hand up, hit your favorite emoji in the chat if you've ever worried about money. Excellent. Well, I have, and I promise that worrying about money is one of the biggest stresses that you'll ever face in your life. It was one of the biggest stresses in my life as well. When I started my business, I hit the ground running and made quite a few sales. Tens of thousands of pounds, in fact. Business was booming, business was great until it wasn't, because my suppliers started wanting their bills paid quicker than my clients were paying me. I had many sleepless nights and the worry about money was crippling. That was the one and only time that I've ever been in debt. But from that point onwards, I knew that I had to figure out money a whole lot better and to manage it a lot better as well. And worrying about debt and worrying about the fear of running out of money are scary situations. And the first step to overcoming them is to understand money better. Being financially literate and continuing to build your knowledge will allow you to create a financial plan to take control of your finances. Where you are now will not determine the rest of your life's outcome, and only you can make the changes you need to achieve that. It won't be easy. Nothing worth having is, and I would agree with that and argue that. But being financially literate or building this knowledge will help you to worry less about money. I do promise that. So, with a financial plan, I was able to look at my numbers and know instantly that I was doing okay. If my budget was out last month, then I knew how to get it back in check because I followed the plan that I'd set. And while you can be as rigid or as loose with your plan as you want, the comfort of knowing it's there to return to provides a huge support in, well, reducing your anxiety. Have you ever looked at investing and gotten freaked out? Put an emoji in the chat for me, please. Have you ever said that you don't know how to invest or that you can't invest because you don't make enough money? Hit a heart in the chat for me there. Or have you ever said that you can't budget because you're not good at maths? Hit the 100 emoji for me in there as well. Money anxiety isn't just about worrying about debt. It's also the doubt that we have in ourselves. Because investing isn't really hard. And once you get started, you'll look back and you wish you started sooner. You will need to learn new things, and that will take time. But at one point you couldn't tie your shoelaces, and like investing, there's a process to follow. And I've tried to remember, is it loop, over, under, loop and swoop? I think that's what it is. I can tie my shoelaces, I promise. But first, you need to get out of your own head. And the mindset that I want everybody to have tonight and forevermore is that you are your own champion. You have to tell yourself straight up that you can do this and commit to learning about money. I know you can do it because I have done it, and I know you will. When I left university, I thought I was done with education. As a 21-year-old, I thought I knew everything. But in my late 20s, I realized that there was so much more to learn. And today, I am still a lifelong learner. At that point, I started picking up books and I became an avid reader. And I credit that to a lot to my own success across business and in finances as well. Being a lifelong learner gives you options. It opens you up to new possibilities, not just in money. And it helps you to navigate the complexities of life, and it does give you the confidence to do so. Money anxiety is scary, but it's only scary because it's unknown. And we'll get through all of that now. Again, you need to be your own champion. If you're in debt and you can't see a path out of it, or you haven't started investing and you tell yourself it's too late or you're behind, or if you tell yourself you're just bad with money because you have no idea where your money comes from and where it goes, or you're just afraid to look. Literally, pardon me, all of this is due to the fact that you haven't sat down and created a strategy to come up with a plan. And that's why it feels incredibly overwhelming. Recently, I sat down with somebody who was in, well, over £20,000 worth of debt. And we came up with a plan to pay off that debt in 16 months. I've also worked with people in their 40s who have never invested a single pound. And when we work through their budget and make a plan for their money, we make plans for a very comfortable retirement at normal retirement age with their current money situation. And when I'm working with these people, you can see the relief and the tension in their faces leave almost immediately. And that's because we sat down and came up with a plan. I didn't throw them a ton of money. We worked through their numbers, their money, and we made a plan. And I can tell you to sit here and get out of your own head, or to, well, I am telling you that, and I am telling you to work to make a plan. But you do have to be your own champion as well, because you can do it, and you don't have to do it alone. So at this point, I say so a lot. I found that out yesterday. I think at this point, we all agree that money is important, and making a plan for your money is something that we should all do. But society tells us that those who want more money are greedy, or that talking about money is rude or considered tacky. And I'm sure we all know somebody who boasts about their wealth. But money is incredibly important, and we need it for pretty much everything in our lives. I do remember a time when supermarkets took cheques, but if you ran down to Tesco today without a penny in your pocket or a pound in your account, you'd leave hungry. And the reality is that we need money. And I doubt there's very many people in this chat right now who would say that they don't want any more. In fact, tell me if you want more money in the chat. Put an emoji there for me, please. So no matter what your financial goal is, whether it's big or small, whether it's near or far, planning is the first step to achieving it. And I'll be the first to admit that money doesn't buy happiness, but the ability to say yes or no to things without the thought of money is incredibly liberating. And that's what money does. It buys back time and it gives you the freedom of choice. The more you have of it, the more opportunity and choices you have. So no matter what your ambition is in life, money is a tool that will help you achieve it. And if nothing else, it'll pay for it. Some of you will want to get out of debt. Others will be saving for your first home. And others will be trying to build wealth for other reasons. No matter what your financial ambition in life is, your goal is no more or no less valid than the next person's. Every journey is unique, but here's the secret: the process is exactly the same. And look, I imagine some of you right now will one day want to stop working, whether that's age 40, 50, or even later in life. Nobody wants to work forever. And you will if you looked at your annual spending each year and multiplied that by your expected life expectancy, retiring would become very expensive. And it is. And yet, in a recent survey by Unbiased, nearly 75% of those in the UK, this is only last month, fear that the cost of living crisis will impact retirement. And it will, unless you plan for it. And I heard a stat last week that 28% of those in the UK wouldn't be able to pay an unexpected £200 bill. And if that's the case now, when these people are earning money and in jobs, the situation in retirement when they have no income coming in will be significantly worse. And look, I'm looking at the chat and I can see some entrepreneurs in the room as well. Those of you who skip off to work every morning and tell me that they'll work forever. Well, I'll be honest, I thought like that for a while as well. And what happens though when you can't through no choice of your own? Well, you'll need to plan for that. So whether you're an employee or an employer, planning for your retirement now and starting as early as possible is really important. So how do we get started then? Well, you can save and you can invest, but these are not the same. Being in a position to save money is a wonderful thing. Look, in today's world where the cost of living crisis and record levels of inflation are decimating our incomes and our real world costs, our life, our ability to spend money, being in a position to save money is a huge achievement. But to build wealth, you do need to find a way to save your money. People often ask me how much they should be saving, and the answer is always more. In the years when I was aggressively saving for my early retirement, I saved 80% of my income. That sounds extreme, and the truth is, it is. But I was very easily able to live comfortably, spending no more money than I was earning previously. And as my increased salary and my income grew, I was able to maintain that level. I didn't let my lifestyle inflate. Yet, this was the catalyst and the catapult to my journey. But many of you have built-in costs of life, and I understand that. I won't tell you to downsize your house or to give up your second household car, but the more savings you can make in your budget, the better. And yet, for all its benefits, saving won't make you rich. In fact, as a saver, you're destined to be poor. Well, not poor, but poorer forever. Saving is great until it isn't, and saving your way to riches will be incredibly difficult. And I can't make bold claims like that without backing it up. So let's look at saving in a little bit more detail. Right, so damn you Monzo, and inflation rates coming down, you had made me have to change my figures. Currently, you'll get a solid 4.5% savings rate in any instant access bank account. That's Monzo from the other day. And I'll tell you, in comparison to the past 10 years, that's solid. That's a great return on your savings. However, with inflation at 6.8% in August, every pound you save is losing you money in real terms by 2.3% every year. So for every £100 that you save this year, you're effectively losing £2.30 every year. Of course, your total wealth will increase as you save, so you're not going to be poor. That's an exaggeration. But you need to build wealth that continues to grow. And we need to do this by making our money work for us and the money that we put in work for us. And let me explain that a little bit further. Let's say you want to build an investment pot or portfolio of a savings portfolio, of £500,000, and you're able to save £20,000 per year at 4.5% return on your savings with a 6.8% inflation rate. Assuming you leave your money to work for you in that savings account over the course of time that you're saving, it would take you 36 years to save that amount. And to achieve this, you would have to save £740,000 to meet that 500,000 future investment value. You'd lose over £238,000 in real money terms over that course of that time. Now, some of you, and I know this because I had the chat yesterday, might be looking at a 5-year fixed rate cash ISA, and you're willing to take the bet on inflation dropping and fixing your savings for a few years. You might win and you might not. And when that term is up, you'll be starting from scratch again. It's a decision that you have to make. By comparison though, investing should make you wealthy. If you were to invest that same £20,000 per year and you were able to achieve a 7% return on your investment after inflation, this would reduce the time taken to achieve your goals to only 14 years. Your total contribution to achieve this amount would be 300,000. But you're probably looking at those charts and going, Connor, what the hell? How did 300,000 become $500,000 in that 14-year period? Well, there was the growth at 7%, and we expect or hope to get this through investing. When we invest, we understand that the investments we buy should outpace savings over the long term, and generally, investments benefit from inflation. As an investor, you also receive dividends. This means as the companies you invest in do better, so should you. And these are, I will agree, very simplified examples, but there's a £400,000 difference in the amount that you would need to save or invest to achieve the same goal. Why would you not save? Or why would you not invest? Oops. As a saver who invests, notice the difference there? Somebody who saves money to invest, we would expect that over decades, our investments will grow. And by keeping our money invested, they should also benefit from a magical thing called compound interest. And I love this quote: compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. And while it is attributed to Einstein, there's a lot of debate online over that. I'm not sure if it is. But whatever the origin is, it's still a great quote to understand the effect compounding can have on our wealth building. Compound interest is the interest you earn on your interest. But what does that really mean? Well, let's look at an example here. If you're sitting on some cash today, and I know a few of you are, let's call it 100k for EV Maz for me tonight, and you're, oh Connor, I'm all pumped, I want to invest my money, and you've picked your investments and you're ready to go. Well, let's say that over the next year, you get a 10% return on your investments. The growth on your £100,000 would be 10k. 10% of £100,000, 10k. If only it was that easy. Now, some of you will be tempted to take that money out and you'll be taking out of your investments and spend it. And I've heard countless people tell me in the past that take the profit. But in my opinion, as somebody who's looking to grow wealth, that would be unwise. So let's say instead of taking that money out and spending it, you leave the money invested for another year. When your investments attract interest on top of the previous interest, this is compound interest. And in year 2, without adding any further money, the accrued interest will be £21,000. The original £10,000 interest that we earned in year 1 and year 2, and then the £11,000 interest we gain in year 2 on top of the other interest. In year 2, you would have earned an extra £1,000 interest. And if you fast forward that 30 years, your initial £100,000 investment would be worth over £1.74 million. Now, this is the most important part of the event for me, because as you can see in that chart, those orange bars start to get bigger. That is your accrued interest. That's the level of interest that you get every year. And the longer you leave your money invested, the quicker it grows. Because this is a question that I do ask most investors who are ahead of me in the game even, and the answer is always they wish they started earlier. But let's go back and look at that previous example in real money terms. This is the exact same data as the previous chart, but it's showing the first 25 years of interest and the total accrued interest on your investments. And I'm seeing everybody moving to the screen, maximizing the image on the screen to see what this really means. Actually, hit me a heart if you did that, because in my head you all did. There are two things to note when it comes to compound interest. The more you can invest early, the better. And the longer you leave it, the more time it has to grow. In year 25, the amount of interest earned in this example is £98,497.33, which is almost equal to your initial investment. As noted in the previous chart, if we left it for another 5 years untouched, your total 1,083,000 would actually grow to 1.74 million. And remember, investing anything is better than nothing. Whether it's £100, £500 or £1,000, the earlier you start, the longer compound growth can work for your benefit. If you want to play about with your own numbers, and I actually highly recommend this, Google compound interest calculator. There's a site called the calculator site, and pardon me, it's a real eye-opener. And personally, it was a huge motivator for me when I was starting to aggressively save for my early retirement or my own financial goals. That's the calculator site, and if you Google compound interest calculator, you'll find it. Of course, right, everything I'm saying tonight and in the previous scenario was pretty simplified. It would be impossible to get a flat 10% return on your investments every single year. The markets go up, the markets go down every single day. But the question I asked and get asked regularly is, how do you get better returns? Usually I work to an 8% annual return for all my examples because I do not know what the future holds. Yet my own investments, which have done quite well, returned nearly 12% on average over the last decade, and that's not accounting for inflation. The short answer is that I get better returns by buying and holding my investments for the long term. And that does pose the question that I know you're all asking me: what do I buy? Well, there are an unlimited number of ways you can invest your money. You could buy rental properties, invest in business, but for the purpose of this event, we'll discuss two types of investments you can make and you can buy, and they are stocks and they are bonds. Now, this is very generalized again. It is a beginner's class, and I will cover this a bit later, but stocks are generally, you're essentially buying little bits or shares within publicly traded companies, and bonds are investments issued by governments that provide a guaranteed return, but it's often a quite low rate. And you're going, Connor, but how do we decide what to invest in and how to invest and what to invest in? Well, you do need an investing strategy. And there are 4 investing strategies that you could choose. There's value investing, growth investing, momentum investing, and pound cost averaging. If you're American, Joseph, I can see in the chat, you would call that dollar cost averaging, but I know you know that. Investing strategies guide your investment decisions. And no matter what your investing strategy is and the one that you decide to follow, you need to have a plan. Firstly, you need to decide how you will buy and sell your stocks and shares or your bonds. And secondly, you need to decide what you're going to buy. Remember, there is a certain gatekeeping in the financial industry, and there's a ton of jargon that is incredibly hard to understand. It is designed to be difficult, so let's cut through all of it right now. So the 4 main strategies you could follow: value investing, which requires investors to remain in it for the long term and apply effort and research to their stock selection, their share selection. Buy low and sell high. That's really what value investing is. Easy? Don't think so. Investors who follow growth strategies should be watchful of executive teams and news about the economy. Growth investors are often looking for the next big thing. And this method of investing involves evaluating a stock's current health as well as its potential to grow. And momentum investing, or investors, buy stocks experiencing upward trends, and then they might choose to sell those stocks and shares that are experiencing downward trends. They believe the winners will keep winning and the losers will keep losing. Now, these momentum investors are heavily reliant on technical analysts, not your dad's mate down the pub. And then we have pound cost averaging. And it is a practice of making regular investments in the market over time. You buy when you have the money to do so, not whether the markets are up or down or what the companies are doing. And for the majority of people, it's the wise choice. For those of us who aren't professional investors with quantitative analysis skills and the time dedicated towards investing, pound cost averaging is the way to allow us to instill discipline in our investing strategy without actually worrying about timing the market or the current opportunities in thousands of businesses across the world. Buying stocks and shares or bonds regularly means that you're buying when the price is high, you're buying when the price is low, and these regular purchases of shares lead to a lower average overall. Yet, for a lot of us, where money is emotional, pound cost averaging allows us then to remove that emotion from investing. And with the platforms that I'm going to mention later on, you can start and continue to invest with only £100 a month on autopilot. And if you continue to do this over the long term, sticking to that plan that you set, you will one day build that wealth far in excess of where you are today. So you might have heard the term pay yourself first. Actually, give me a little thumbs up in the chat if you've heard of that before. I'm going to keep moving just because it's 10 seconds and it's very long when you're sitting on this side of the screen. This is the process of automatically investing each time you get paid. And that's exactly what paying yourself first is. You're paying yourself before you look after everything else. And this is just part of the process of developing your investing mindset, because putting your money away for the long term isn't easy. And for a lot of people, it's not normal. If you live like no one else now, later you can live like no one else. That's by Bob Proctor, I think. I actually can't remember who it's by. But we live in an era of instant gratification, and investing over the long term is boring. I tell you that from somebody who's done it for a decade, which is not a long term. For many of those who are new to investing, it can feel like deprivation. You're giving up those #YOLO moments for a far off distant promise. Saving and investing for the long term isn't easy, and there will be days, weeks, months, and years where you question if it's all worth it. Look, if I offered you the chance to buy, or the money to buy, a Hermes Birkin bag, apparently a Birkin is something else, so it's a trip or something, but a Hermes Birkin bag, or a trip to the Maldives today, many of you would take it. But those of you with an investor mindset would realize that by delaying gratification over decades, you'd be in a far off better financial position. And somebody yesterday asked me how to stick to this, and that they find it very hard because, well, you could die tomorrow. And my answer straight back to them was, what if you didn't? You need to plan for your money. And this delayed gratification, or lack of it, is one of the two main challenges that investors face. Well, actually three main challenges: delaying gratification, not sticking to the plan, and the last one that I came up with this morning was, well, actually not just having enough to invest. Let me know who in the chat has bought an item and gotten a serious amount of joy from that purchase. What was it you bought? Really long time, 10 seconds. Brilliant, a car. No, I'm not fan of pets. Sorry, Joseph. Absolutely fine. That's what. Yep. Yeah, 2 pints, please. Look, now hit your favorite emoji, and I'll keep moving forward on this one. If you've gotten the same amount of joy buying investments or putting your money into savings accounts. Right? Here's the truth. I have. And it's something that I credit with being able to save and invest enough to retire early. The focus and the more focus you have in investing, the quicker you can achieve your goals. And when you understand that investing isn't taking away from your future self, but buying freedom in the future, then you start to look at it a lot more differently. And that's how I thought about it. Because when I was making purchases of shares, I was assuming that was a new holiday. Well, on this side of things, I can tell you that was completely worth it because I've had a 13 weeks holiday this year. And the second challenge that people rarely stick to, the second challenge that most people face is that they rarely stick to the plan over the long term. When in fact, by doing just that, it's the primary reason that they'll achieve their goals. I'm pretty sure many of you have been told that investing is gambling. And I know when I first started out, my parents, hello mum and dad, I know you're watching, told me to be careful. And a lot of us will have heard horror stories about people losing fortunes on crypto or those who have been scammed and are sent money off to the foreign lands. And you should be mindful of these because these situations do happen. But a more likely scenario, and the one that I seem to face with every investment that I make, is that the very next day the markets drop in value, and so does the value of the money that I've just put into the markets. It happened this week. I put some money into the markets, the stocks and shares dropped the very next day. Many people who don't have an investing mindset will see this and they'll panic sell. They had no plan for their money and they assume that stocks just go to the moon, they just go up, but by selling they've locked in their losses and they go out of the market and they call it a scam immediately. And make no mistake, the value of your money will go up and it will go down every single day. You'll see changes in the value. But generally speaking, over the long term, we expect them to trend upwards. I say that. Yet during the pandemic, my investments were down 30%, pretty much overnight, and that was a hard watch. Events like the financial crisis in 2007, the pandemic, and the dot-com bust in 2000s happen. It feels like they're happening more regularly, but rather than looking at these with fear, we have to develop that investing mindset and look at these as buying investments on sale. And because we intend to buy these investments regularly, we follow the markets up and we follow the markets down using a pound cost averaging strategy. And what that does is that spreads the risk and lowers the average cost of purchase over the long term. Let's look at an example. This is Sally and this is Craig. They are no way illustrations or depictions of people I know. Anyway, Sally and Craig are on their investing journey and decide that with every pay packet they'll buy just one share. At the current price of £10, this share costs them £10. Next month, the value of the shares has decreased and the price of the shares are now £5. Instead of panicking and selling their original share at a loss of £5, they continue on their investment journey and again buy £10 worth of shares. For £10, they were able to buy 2 shares this month. The following month, the market recovers and the price of the shares are now back at £10 per share. Again, Sally and Craig buy £10 worth of shares. Over the 3 months, their investment of £30 was able to buy 4 shares, which are now valued at £40. Buying consistently over the long term while the price fluctuates benefits us, and this is pound cost averaging. It also means that we understand dips in the market are not to be feared because we're buying our stocks and our shares on sale. To develop this investing mindset, we must think about these investments without emotion. And the way to do this, again, is to create a plan for our journey. Pound cost averaging is great, and it's a strategy that I used along my investing journey. I committed it to paper as early as 2013. I actually still have the document today. And while my real world plan deviated somewhat from that and what I had anticipated, I always went back to the plan or the strategy when my emotions started to creep in. Exactly what I did during the pandemic, because my stocks and shares were down 30%. I had feared that I was going to lose everything. But I stayed the course, kept investing, and well, they've come out the other side. They're nearly where they were before, and they're doing just fine. And because my financial plan was set in a period without emotion, you can always go back to it instead of making off the cuff or rash decisions due to that emotion. Right, some of you know me very well, and you know that I'm a huge fan of self-development, property, and of course business. And these are highly profitable investments that people can often make. But for the purpose of this event, we're talking only about investing in the stock market. Generally speaking, you can invest in bonds or stocks and shares here in the UK. I said earlier on that there are other ways to invest in the stock market, but the majority of us won't go past these two investment types, so we're going to focus on these tonight. Stocks and shares, which are also, you might hear them referred to as equities, are these little pieces of publicly traded companies. So these are the stocks and shares that you're buying. You're becoming a shareholder. And some of these companies you will know, like Vodafone or Sainsbury's, and there are others that you'll have never heard of. And when you're buying a stock or a share, you're buying a little piece of that business. You become a shareholder. Bonds, on the other side, are issued by governments and corporations, when they mostly governments with the bonds that we would buy. And by buying a bond, you're giving the issuer a loan, and they agree to pay you back that loan at face value plus a little bit of interest. Bonds do give you stability, and they give you a fixed stream of income, and they offset a lot of the volatility that you might see from owning stocks. But you don't necessarily benefit from a company's growth, for example, and because of this, the interest that you attain from buying bonds is usually a lot lower than stocks. It is, isn't it? Give me a heart, please, if you followed so far. Please. At this point, you are probably saying to yourself, though, Connor, you said tonight's going to be an easy listen, and you probably have a few questions right this second. You are asking, what stocks do I buy and why? I've no doubt. You're asking, what bonds do I buy and why? You're asking, how do I decide how much to buy each month and why again? And, well, how do I match these goals up with my long-term financial plans? These are all valid questions. Every single person in this room will have that. I had it as well. Yet, apart from the last point, I'll be completely honest with you, I haven't got a clue. When it comes to individual stock picking, you could write all of my knowledge and understanding on a single A4 sheet, maybe a little bit more, but a single A4 sheet, double-sided, and it wouldn't be much. But the good news is that you don't need to know, and let me explain why. My philosophy on investing is that I want to spend as little time as possible managing my investments. I also do not try to beat the market or pick the next hot stock, because over the long term, the percentage of people who can do that is next to zero. And I'd like to introduce you to my mate, my very good mate, best friend Warren. Some of you might know him, some of you might not, but this is Warren Buffett. And starting from nothing, he has accumulated and built a wealth of over $80 billion with a B, 80 billion. And if you'd given him $1,000 in 1964 and let him hold on to it, he'd be giving you back a cool $10.5 million today. Warren is an outlier. He has huge teams of people, unlimited resources, and his own ability to pick stocks means he is regarded as one of the best, if not the best, investors in the world. Yet, he tells us how to invest, and it's not picking stocks. He says, the single best thing you could have done on March the 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. Just like you would do when you bought a farm, you would just buy the farm and let the farmer run it for you. His advice is clear. Buy index funds and hold them for the longest time. But what is an index fund? Well, have you heard the phrase, don't put all your eggs in one basket? Well, imagine your money is the egg and the company is the basket. If you run out and buy shares in Sainsbury's and these alone, what would happen if Sainsbury's lost its value in the morning and the price tumbled? The basket drops and the egg would smash. There would be no omelets for Connor in the morning. Very sad days. An index is a group of companies. Common examples that you might have heard of will be the FTSE 100, the FTSE 100, the FTSE 250, and maybe the S&P 500, which is in America. The index could be grouped together due to size, as is the case with the FTSE 100, and that's the top 100 companies by market size capitalization in the UK, and the S&P 500, which is the top 500 in America. Indexes can also be grouped by the type of sector that they operate in. The NASDAQ, for example, in America, the NASDAQ index is the top 100 technology sector companies in the USA. And an index fund is a way of buying all of these companies in the index at once. Think of it as a basket full of baskets. And this is the ultimate benefit of an index fund, diversification. If you buy an index fund, you're buying the whole market, the whole index, in one investment. You don't need to buy each individual stock, and you don't have to figure out how to balance the amount that you buy or when to rebalance any of these, because the companies will do well and won't do well. They'll fall in and out of favor with the index fund. You don't need to manage any of that. And that's actually an important point to note. With an index fund, you're buying all the winners and you're buying all the losers. You're not trying to pick the next winning stock, but rather follow that total index. And you might hear or might have heard of the term tracker, and that's exactly what index funds do. They track the markets up, they track the markets down. Pardon me. And to reiterate why we do this, regular investors, pardon me, you and I, rarely and consistently beat the market returns. In November 2022, the FTSE 100 had returned an average annualized amount of 12.89% over the last 10 years. And some indexes will have done better and some will have done worse. Yet while it's impossible to calculate how many investors beat the market consistently over that same period, statistically it's unlikely that many will. Certainly it would be beyond my normal person's ability and many people like me. We don't have time, access to resources, or knowledge about those things. And according to the S&P Indices versus Active Scorecard, more than 95% of American domestic active stock fund managers underperformed the respective S&P benchmarks over the past 20-year period up to the end of 2021. So what that means is 95% of active stock fund managers with access to huge teams and unlimited data and resources can't beat the market. So how can we? Well, the answer is, well, I'll save you guessing, we can't. And that means that index funds are friends of investors like ourselves. They simplify the process of investing and they invest your money along with millions of other people's monies in a transparent manner across hundreds or thousands of individual companies. The other main benefit of index funds is that they generally have very low fees. And if we go back to my mate, best friend Warren once again, the second part of his quote explains that we should buy and hold for the long term. On any given day, the price of an individual share can skyrocket to the moon or plummet through the floor. And these short-term events are flattened by the diversification that you have in an index fund. But they are still applicable because with an index fund, you're buying all of the companies and external factors can affect each of these companies collectively. Because let's think about it again. If we go back to pandemic and that period between 2020 and 2021, almost overnight, the value of the FTSE 100 dropped by 30%, just shy of it. This short-term impact has, as I mentioned, since recovered, and the value of these companies within the FTSE 100 has collectively reached pre-pandemic levels. There will, however, be some companies in the FTSE 100 who have massively benefited from the pandemic and this change of life that we now live in, and there will others who are no longer in business because of it. In the short term, market dips and markets grow largely based on news. You'll see sharp peaks and sharp troughs when you zoom in closely on the daily changes of the market, and you can see that there in the little illustration. Yet if we zoom out to a wider time frame, the peaks and the troughs start to smooth out somewhat, and you'll see big movements in the market. And I did mention the pandemic, but if you went and looked at the chart of the FTSE 100 over the last 50 years, you'll also see the financial crisis of 2007 and the dot-com bust of 2020 or 2001. These are called black swan events, and they shouldn't happen that often, but it does feel like they're happening more frequently. And yet, if you stay invested and keep on track through pound cost averaging over the long term, these are moments not to be feared or to be worried about. I say that you still will, but you'd rather you realize that these investments are opportunities to buy on sale. So as my mum and dad would say, fill your boots. And if you look at the decades chart then, over the longest term, we generally expect that curve to be a lot smoother. Now, that is a strategy that my best friend and world's greatest investor, Warren, recommends. So click on your favorite emoji, please, if you want to learn how to start investing. Brilliant, lads. Thank you very much. Thank you. Well, here in the UK, there are 3 types of investment accounts that you can open. We have self-invested personal pensions, which are SIPPs. We have stocks and shares, ISAs, and we have general investment accounts. SIPPs are self-invested personal pensions, and generally speaking, if you're in employment, your workplace pension might knock out the need for a SIPP. However, you can have a SIPP and a workplace pension simultaneously, and having both of these pensions can increase your options in terms of investing for retirement. When I owned my own business, I did try to find a workplace pension provider that offered a wide variety of investment options with low fees. The reality is though that many of these providers have higher fees than I would have liked, and there is little by way of support when our team were choosing how to invest their money or what options were actually available to them. But as an employee, your workplace pension is part of your salary, and if you don't contribute to it, you are leaving part of your overall salary on the table. Generally speaking, taking your workplace pension up to your employer match is generally always advised. For those of you who are self-employed or company directors, you can put up to £60,000 per year into your SIPP. And if you opened your SIPP a couple of years ago but didn't fill it, you'll be able to backfill this up to 3 years with 2 times £40,000 because the rules did change there recently. SIPPs do offer a huge range of investing opportunities, including index funds. In addition to this, you'll have to speak to your accountant to confirm it, but you can put commercial property in there too. And I know some people who have done that before. And the main benefit of a SIPP is that it's funded from any pension is that it's funded from your pre-tax income. This means you do not pay any money on the tax that you invest in a SIPP. The money in the SIPP also grows tax-free, and when it comes to withdrawing that money, you pay tax at their current income tax level at that point. The challenge with pensions is that in general, they are at the mercy of government changes. There were big changes in favour of people like ourselves just recently, but if Labour gets in, the chances are that the lifetime allowance will be scrapped because that's what they say they're going to do, and in future then it may be reinstated if somebody else does it. My view is that we have to work with the rules and the regulations that are in front of us right now with a knowledge and understanding that those plans might have to change. Currently though, your SIPP can be accessed 10 years, and your workplace pension can be accessed 10 years prior to the state pension age. And for someone who's in their early 40s like me, currently that means you're going to get your pension at 68, your state pension at 68, and you'll be able to then take your workplace pension at 58. If you're younger than I am, that's likely going to increase. So some of you will want to retire before the age of 58, and some of you will want to build wealth outside of your pension. And that'll allow you to counter any of those potential government changes. And a stocks and shares ISA represents the perfect opportunity to grow your wealth in a tax efficient manner. Note, we're talking about stocks and shares ISAs, not cash ISAs, not LISAs, not any of those. Because remember, saving your way to wealth is a lot harder than investing. And at the time of writing, you can save up to £20,000, save and invest up to £20,000 across some or all of your ISA types. And for the purpose of this, I'm going to concentrate solely on your stocks and shares ISA. A stocks and shares ISA is different than a pension in that it's funded from your after-tax income. You'd fund this from any money that you have in your budget after you pay all your expenses every month, rather than that pre-taxed money from your employer as well. And the growth of your investments in your ISA, your stocks and shares ISA, grows completely tax-free. And then when the money is withdrawn, it's completely tax-free as well. And most importantly for people on this call now, there is no time restriction. So you can withdraw your money at any age prior to 58. You can withdraw at any age after 58 if you want as well. And for some of you lucky people who have the ability to invest over £60,000 in their SIP and over £20,000 in your ISA allowance, there might be a time when you want to open a general investment account and fund this from after-tax income. There may also be a time when you want to forego your SIP investments because you're getting closer to retirement, or you need to find cash to fund your pre-retirement time as well. And a general investment account allows you to invest just as you would in a SIP or in a stocks and shares ISA, but there is tax to be paid on the capital gains, the growth of your money, and also the dividends that you receive from the companies. Now that we have covered the importance of investing, in doing so frequently and over the long term, what to invest in and how, finally, I have no doubt you're all saying we need to look at buying your investments. And for the purpose of this event, I'm going to show you how to invest in a platform called Vanguard. Please let me know in the chat if you have heard of this company before. But John Bogle, the founder of Vanguard, is credited with creating index funds back in 1975. And there are hundreds of index funds available to buy in the UK across dozens of companies like Vanguard. And this is just a reminder that this isn't a recommendation of Vanguard as a platform or whether a recommendation of which index funds to buy. I'm not allowed to do that. Personally, I use quite a number of platforms, including Vanguard, and the majority of these platforms will allow you to invest in index funds within your SIP, within your stock and shares ISA, and also in your general investing account. The choice of platform though, whether you want to choose an app or an online platform, comes down to your personal preference based on what you're most comfortable using. For me, I like web apps. For people that I know, it's an app on their phone. For further research, you might want to review each of these or other platforms, compare the funds, the index funds that they offer, and then check out the fees that they charge. I hold accounts with Freetrade, AJ Bell, Interactive Investor, and Hargreaves Lansdown. They're all great companies, and there's none necessarily better than the others. But for the purpose of this event, I'll show you how to buy index funds with Vanguard. And once again, this is not a recommendation. I'm showing this for illustrative purposes solely. And before you ask, no, Vanguard isn't sponsoring this event, in case you thought they were. And true to form, I had a full run through of this buying investments within Vanguard, prepped all the way through to the very end last week, and Vanguard changed the entirety of their site say a few curse words, I'll not lie. So I'm doing this fresh, and I'm just going to show you all the way through all the different funds that you can buy without actually doing the purchase, because they don't allow that now. So please bear with me 1 second. Send me a little message. Tell me how you think it's going in the chat. If it's nice, if it's not, don't. While I get this set up. Awesome. Great. Okay, now, first things first. Thanks, Joe. Thanks, Declan. Thanks, Joseph. Connor, you rock too. This is Vanguard, and this is their site. vanguardinvestor.co.uk. Now, please make sure it's vanguardinvestor.co.uk, because vanguard.com and the other sites are the American versions. But with Vanguard, as I've mentioned, you can... I'm from Lisburn, Scott. Thank you, everybody. Our accounts in. So we can open an ISA with Vanguard, and only last week with the update of their website, they opened this new Vanguard managed ISA. I have not looked at this yet myself, so I can't give any comment whatsoever. You can open a junior ISA for your children who are under 18. What is you have to be mindful of is that any money you put in a junior stocks and shares ISA is legally your children's money, and is legally your children's money at age 18. They get access to it, full access to it. So you have to be mindful of that as you're putting it in. Give your kids some knowledge and understanding about finance, and they'll manage it perfectly. You also have the general investment account that I mentioned, and we then also have the Vanguard personal pension, which is a SIP. For the purpose of the illustration tonight, I will be buying this in the Vanguard ISA, but we'll get to that in a minute. What I want to show you here is the list of funds that Vanguard sell. And I'm going to explain those a little bit further, because it's very important that when you're buying index funds, you understand what you're buying. First and foremost, you can build your own portfolio, because you can buy individual funds. If I go to UK here and I look at the UK funds, the region of the UK funds, well, they have the FTSE 100 Index Unit Trust, and in that they've got 110 holdings, which are slightly more than the FTSE 100, but this is a makeup of the top 100 companies in the UK. And if I click in to the fund details and check on the fund data, I'll come back to this and explain it all in a second, the portfolio data, and scroll down here, well, we can see that this particular fund, the FTSE 100 Index Unit Trust, has AstraZeneca, it has Shell, it has BP, it buys all of the top 100 funds or companies in the UK, and it buys this at varying percentages. It rebalances based on the percentage that that company holds in the FTSE 100. I'm going to go back again. As I also mentioned, we could buy the S&P 500. Hopefully this clicks. Definitely shouldn't say. Right, I'm going to have to refresh this. Definitely shouldn't say UK when it's in the US. Okay, as you can see then, it has, never works live. You can also buy the S&P 500, and if we look at the portfolio data here, we can then scroll down and see that, well, this has Apple, this has Microsoft, it has Amazon. So it has all of the shares that people are talking about. It also has Warren's company, Berkshire Hathaway, in there as well. And this is important because if you want to buy index funds, you're buying all of the companies in that index. You're buying a little percentage of each of them. And if we go back here to this list, we can search through Vanguard for those individual funds based on the indexes that are in the UK, the US, Japan, all around the world. We can sort these by our risk tolerance. So if you're risk adverse, you can go with a level 1, or if you're more accepting of risk, you can look at the level 6 funds and look at that. They also look at active and index funds, because that's something I need to explain here now. I mentioned earlier on about active investing and how those 95% of active investors couldn't beat the market. Vanguard offers actively managed funds, but they are more worldwide recognized for their index funds that track the market. But you can still buy them with a platform like this or on any of the other platforms. And all of those other platforms will have a wide variety of other index funds that you might choose to go and look at. And the last thing that I want to look at on this column to the left is the income distributing and accumulation share classes, because a lot of people won't know what that means. When you look at the index funds and you're choosing to buy an index fund, you'll see ACC or INC, which is accumulation or income. Pardon me. And when you buy an accumulating share class index fund, the money that you get from dividends from each of those individual companies is automatically reinvested into the index fund. And those with an INC, or an INC, or an income distributing share class, the money is then distributed to you, those dividends is distributed to you as cash in your Vanguard account. Now, if you were to leave them both side by side, they would be worth exactly the same value, except if you want to have hands-off index fund investing, you would use the accumulation, because that will just automatically reinvest that money for you. And that's where you start to gain that compound interest effect. Whereas the income distributing share class, you'd have to go in and manage those investments or take that out as an income as well. And you would be taxed on that if it was outside of your SIPP and your stocks and shares ISA. You wouldn't be taxed on it on the other side. Sorry, that's not 100% true, because you'd be taxed at income tax level on your SIPP. Right, now you can build your own portfolio with all those different equities, and down here the different things. You could buy bonds within Vanguard as well, which a lot of people do. But what they are known for worldwide are their index funds. They're ready-made, off-the-shelf index funds, and I'm going to look at these in a bit more detail. We have the Life Strategy funds, of which there are 5. And I hope this... No, I'm going to have to refresh the page again. My apologies. But what this does, these index funds, instead of just buying a basket full of baskets, they buy a basket full of baskets across all of the index funds. And let me explain that a little bit further. If we look at the Life Strategy 20% equity fund, if we look at the fund details again, and we go into the portfolio data, rather than it showing all of the individual companies that it has bought, it shows you all of the different funds that it's bought. And the benefit of something like this is you get global diversification. You're buying all of those different funds across all of these and all of the different companies that are in that. And what these funds, how they are differentiated, is that there are different levels of bonds purchases within each of these funds. So for example, the Life Strategy 20% equity fund, it has 20% shares, equities, and 80% bonds. On the risk level, it's a 4 out of 7. But if we look at the 100% equity fund, it has 100% shares and 0% bonds. And all of these in between are at varying levels of bonds versus stock purchases. And if you look at these, you can see the number of holdings in that. You've got 26,000 individual companies and bond holdings. And in the Life Strategy 100 equity fund, you have 7,000. Now, the last thing that I'm going to explain on this page right this second is this ongoing custodial fee, which is the OCF, the charge. And I'll explain why fees are one of the most important things you can do in managing them in investing very, very shortly. But just note that these are 0.22%. That's quite low. And that's what Vanguard are known for, having low cost access to index fund investing. But let's also look then at their ready-made portfolios and look at their target retirement funds, because these are even easier. They help people to invest at an even easier way. And the difference between the target retirement fund and the lifestyle strategy or the Life Strategy funds is that these funds automatically rebalance when they get closer to their target date. If you look here, the retirement fund, which is 2015, which is already passed, the shares are 30% and the bonds are 70%. Whereas if we look at the target 55, it's 80% shares and 20% bonds. Now, the reason that these funds rebalance is because the closer you get to retirement date, or this target retirement date, generally speaking, you want to have, well, not that you want to, generally speaking, the advice or the information or the expectation is that you want to stabilize any roughs and smooth out the rough patches in the markets. And to do that, you buy more bonds. So as you get closer to that target retirement date, you'll see a greater bond holding. Now, there is also an argument that you always want to have equities, and I'm not going to debate that here on this call. I know what I think, and certainly you will have your own opinion at a later stage. But these will start to rebalance, and over time that will go from being quite high percentage of shares to quite a low percentage of shares as well. And what I would advise you to do with this is to look at each of the funds in here, whether or not you're looking at individual index funds or whether or not you're looking at the ready-made portfolios here. Look at what they are made up of. Research the index funds, see what percentage of stocks and shares there are, and make your own decisions. There's an argument that if you're younger, you can be a bit more heavy with your equities, and there's an argument that if you're starting late, you might want to be a bit more heavy with equities. But there's also the same argument on the other side. So it's really up to you to start looking at that and starting to make your own plan and decide what works for you. And what I like about this site in particular, and all sites do have it, but this new update for Vanguard is very easy to review, because what it does is it shows you the past performance. And I'm going to explain this a little bit further, because being in bonds and being heavier in bonds doesn't necessarily smooth out those curves, and maybe sometimes it restricts your growth. If we look at the last 5 years of performance on the Life Strategy 20% Equity Fund, during 2019, 2020, during the pandemic, that's that period during the pandemic, it had a growth of 2.58%. Whereas this same period, and this was a very massive period of turmoil in the economy at that time, well, it had a 1.9% growth, 1.95% growth. So there's only really 0.5% thereabouts, 0.6% difference in that growth during that time. But when the economy came out of that period of disturbance, let's say, which was the 1st of September to 20 to 21, this particular fund had a growth of nearly 25%, whereas the bonds fund that was very heavy in bonds, 80% bonds, saw a growth of 5.36%. And I know that a lot of people are risk adverse, but by being heavier in bonds, it's important to note that you might also be losing out on the opportunity when the markets do well. And as you can see, you would have lost out 19% of growth during that year. Again, not providing any investment advice, can't do that, not allowed to do that, just showing an illustration of what the difference in bonds and shares had in the real world. And it is incredibly important to note that past performance is in no way an indication of future performance. So please spend hours, spend minutes, spend as long as you need going through the Vanguard Investor site, because it really is easy enough to understand. When you start looking at the data and you see what it means and what that really means, then it does become a lot easier to manage and to really look at your investments with an objective view and pick the right investments for your investing strategy. Now, I'm going to go back to, hello again, I'm going to go back to my slide deck, and we're going to have a look at fees and why those matter, because I have talked about these a couple of times now, and fees, as I said, are one of the most important things that you have to understand when it comes to investing. So this is loading on this page here. I'll just get it up now. Excuse me. Okay. So glad that worked. Okay. Right. Why fees matter. Yeah, did work. Okay. There are many reasons why I prefer index funds. And I've said it for a few times at this point. A big part of that reason is fees. Because what feels like the smallest number, 0.22%, 0.24% ongoing custodial fee, can make a huge difference to your wealth. And when it comes to investing across any of the platforms you look at, there are 3 types of fees that you need to look at and you'll come up against. The first one is the platform fees, and those are the fees that the provider will charge you for holding your investments on their account. And Vanguard, I think the maximum fee you can pay per quarter is 375 quid, or as a percentage. There are cheaper platforms out there, so do have a look at them. You'll have ongoing custodial fees, that OCF fee that it mentioned, and these are the cost of holding the fees charged by the fee provider. And finally, the third fee you'll have is a management fee. And this is the charge from your financial advisor to manage your investments. And I have heard some horror stories of investment advisors, financial advisors, robo-advisors, not real people actually, charging up to 2%. And that's a lot of money. And as you can see there, a 2% fee would have a £221,000 difference from having a 0% fee over 30 years. And what we do in that calculation is that I'm looking at that saying we're investing £500 a month every month for 30 years. We're assuming that we get a flat 8% or an average 8% return over those 30 years, and then we're taking away the cost of the fees. So at that point, if you were able to invest £500,000, your total amount you'd have of investments would be £713,000 at 0% fees. And if you worked it all the way down to 2% fees, you would have £492,000. So there is a huge difference when it comes to your investment value when you're managing your fees. So do look at those very, very carefully. And getting back to the challenges new investors face, I did mention that there was 3 of them, and I've covered the first 2. Delaying gratification, you need to be mindful of that. You have to put your money away for the long term and realize the benefit in doing so. You need to stick to the plan for the long term, because all these shiny objects and all this different, all the chassis heading around or in the world, we have to be chaos in the world. We have to be mindful to stick to our plan through thick and thin. And the third thing is that most people I speak to tell me that they don't have enough money to invest, because right this second, money is hard to come by. Many of you will be earning more money than you've ever earned before, but by the same respect, there's little at the end of the month, and there's very little or nothing to put away for your future. And this is normal, not because it's right, but because absolutely everybody you know is doing it. We buy nice cars, we go on holidays, we want a bigger house, we want to look like we're the Joneses, and we do that when we can afford it. And I agree that if you work hard, you deserve to spend your hard-earned money. Yet, as we grow older, our lifestyles inflate, and naturally this means that our life will start to cost more. And even though these incomes are increasing, you never feel like you're getting ahead. And I ask absolutely everybody that I speak to about their finances, the first question I'll always ask them is, do you have a budget? And yet, for practically everybody I speak to, it's a huge no. And while you'll hear this from me every time I speak, budgeting is the cornerstone of any financial plan, yet it's rarely a priority, never a consideration, and yet it's the one thing that you can do to take control of your finances. And going back to paying yourself first, if our goal is to increase our investments, how are you going to manage this? Without a budget, you'll not know the headroom between your income and your expenses, nor will you be able to advise or optimize your spending and keep an eye on the areas that you need to work on. You won't know how much you can invest without a budget, and your goal in life is to make as much headroom between your income and your expenses as possible. Tell me in the chat, put it in a little emoji there, if you've ever felt overwhelmed by the thought of managing money. Because the thought of managing money is a huge hurdle to overcome. Money anxiety doesn't just happen to those people who are in debt. I have met plenty of people who make 6 figures a year, they're in their 30s, in their 40s, or 50s, and they feel like they're behind. They know they should save money, and they know even more so that they should invest their money, but they bury their heads in their sand because setting a budget and making the lifestyle changes that they think they need to make is incredibly tough. But when you break down your goals and create a plan for your money, and then you set that budget into place to afford it, the unfathomable things that you think you can't do become manageable. And I do have the perfect solution for you, and that will help you to manage your finances. Tomorrow morning, I've spent all my effort for the last 12 weeks putting this together, but from tomorrow morning, I'm starting to build my first online course. It's due to release in mid-October, and it's going to be called Mastering Budgeting. And this course is going to be a comprehensive guide and plan for those who want to take control of their finances and manage their budget like a pro. And I'm going to stop right there because this will be a paid for course. The time and effort and the money that will take to create a quality learning resource like this will be considerable, and I do intend to charge for it. But everything else I ever have on my website, on my YouTube, will always remain absolutely free of charge. For those who need it, there will always be plenty of resources, and my Founded Money channels will always be free, and they will help the majority of people to make themselves betterly prepared for financial well-being. However, this course is going to be incredibly comprehensive, and it'll be a step-by-step guide to create rock-solid budgets, saving you a lot of time and I hope a lot of money as well, and probably stop you making all the mistakes that I made, I hope. All of this content will be online. It'll be available in video content, and it'll be available in very easy to understand modules. It will include 10 very comprehensive modules, and that'll have 60 easy to watch videos. And for those of you who pre-order tonight or in the next 24 hours, it'll be 198 quid, which is £98 or £100 cheaper than it will be on the official launch in October. And because you're the first people that I mentioned, don't think I've told anybody about this yet, to be honest, I'm going to give you a few bonuses to help you make the most of this course. Firstly, you're going to get exclusive access to help shape the course content. I'm going to do a live group call to help you build your investment and your personal financial plan, because I've talked about that a lot tonight, and I realized that I don't go into enough depth in that in this call. So I'm going to do that a lot with a lot of people separately in another call. And then finally, I'm going to hold a live Q&A event exclusively for those pre-order customers to help them to chat about budgeting, look at the challenges they faced, and make this course specifically there to address their needs. And you will also get lifetime access to all the content and everything else that comes with it. Will this course benefit you? I hope it does. And I wouldn't be creating it if I didn't think it would provide every single person who buys it far greater value than the money that it's going to cost. And the money and the profit that I make from this is going to go into building Founded even further and bringing this content to even more people. It's something that I would expect you all to reference now, in the future, and over the course of your saving and investing career. It's going to be perfect for those who want to learn how to budget, achieve their financial goals, secure a financial future, and I'd like to say improve the quality of your life, because with better money management comes less stress, more freedom, and the ability to have a more satisfactory life. That's a sales pitch. Look, if this saved you hundreds of thousands of pounds, allowed you to pay off all your debt, helped you to invest your money wisely, removed the stress about money, and set you up to have a better life financially, would it be worth it? I hope it will be, and I hope people will expect that as well. And that is what I wanted to achieve. Right, so if I did all those things, would that change the opportunity to change the direction of your life? Or would you continue to feel overwhelmed and stressed by the thought of money and the idea of retirement? And if you pre-order before 7 p.m. tonight, you'll get that discounted rate and you'll get those free bonus things that I mentioned. You can go over to founded.co.uk, click on the Mastering Budget link at the top or the bottom of the page, or you can see the URL there on the screen, and I'll share that in the chat now also. 1 second, do that. Thank you. Shit, that's at the end. Look, that is the end of the selling. I want people to buy the course, but if you don't buy it, there are plenty of resources on Founded that you don't have to to do so, but I do expect there to be a lot of value in there, and I hope some people do buy it because it gives me an opportunity to bring my content to further people. I want to thank you all for joining me tonight. You have given me an hour and 35 minutes of your time so far. I really appreciate that. And to all the people who are watching right now who have helped me along the way, Leanne, Joe, Suzanne, Mum and Dad, everybody on Marty as well, don't forget him. I appreciate you all giving me the advice and the knowledge and all your support as well. I'm going to go into the live Q&A because that's enough selling. Thought I was done with selling when I sold Kaizen, and I want you to please share your questions in the chat, and I will try and answer as many of those as I can. If I can't answer it and I don't know the answer, I'll just tell you. What I will do is I'll go away and research it and come back afterwards. Look, thank you all. I appreciate that. God, it's done. Whoop. I have to wait now. Will I be covering savings accounts and how to use them? Yes, I will. There are quite a number of different savings accounts now in the UK. There are a lot of online banks like Monzo who are often offering instant access accounts and things like that. I will have a whole section on that, and yeah, actually I'll cover that in great detail. I think there's a whole module on banks and savings accounts and what way to use them, the likes of creating a sinking fund, an emergency fund, all those good things. Absolutely. How will I be covering savings? No, I've done that one. Do you recommend prioritizing clearing debt versus investing? Yes, this is one that I have covered a few times, Kev, actually, and I'll share a link with you afterwards. But in reality, the first thing that you want to do is to set your emergency fund. Now, first and foremost, get an emergency fund of £1,000 if you can. That's your first priority before you even start thinking about investing. Because the worst thing that you can do is go into debt. And actually, if you have any debts, paying down your debts are first priority. But if you are saving your emergency fund, then you will not have to go into debt. And debt costs you money. All that stuff I talked about, compound interest, debt is literally the mirror opposite of that. So you want to stay out of debt as much as possible. And when you've got that £1,000 emergency fund at hand, then what I would suggest to do is you start looking at your investments. At that point, be ready to start putting some of that new money that you have to it. While at the same time, I would suggest starting to build your emergency fund out to 3 to 6 months. I know you're in employment, Kev, so 3 months of your essential spending. That's your goal in your emergency fund. So you can do your first £1,000 here and then start trickling it up to that 3 months of essential spending while building out your investment plan here. And then once you've got your emergency fund nailed on and sitting in a bank account earning you a few 4 or 5%, then go full tilt at your investments and you too as well. Actually, you bought me that, so thank you. Right. How do you decide how to overpay your mortgage versus how much to invest? Same question. Pay down your debts, pay off your mortgage. I paid off my mortgage before I started investing because that's all I knew back then. If I had invested before paying off my mortgage, I did the calculation, I'd have had about £10,000 more in my investment accounts today than I would have had back then. Yet the sound sleeping in my bed over the last 14 years, for paid off my mortgage have been well worth it. So you can do both. Do both at a level that you're comfortable with. Okay. Do you offer one-on-one classes? Yes, Johnny, thank you for asking. I do. If you go to the Foundred website, I'll send you the link here now. I have personal financial coaching classes. I thank you for asking. That's much appreciated. There is a charge for that, and certainly I've done those with quite a few people where we'll sit and we'll chat through your personal situation. And as I said earlier on, a lot of the time it just comes down to making a plan and figuring it out, and that covers whatever it is you need. Those conversations can be just about finance, or they can also be a little bit about business too, depending on what your situation is as well. And we'll talk about it all. So it's all very loose and it's very fluid until we start getting into the detail. Any advice for setting up funds for kids? Yes, I have an article on my website, Michael, and it's How to Make Your Kids a Millionaire, I think it's called. Certainly, very quickly and easily, if you put £9,000 into an index fund or an investment fund and it achieves 8% over the course of your child's life, by the time they get to retire, they'll be a millionaire. So stocks and shares ISA or a junior SIP, if you want to put the money away for a longer term for them, you can start filling that up, and it's just the same as you putting your own money into an ISA account. And certainly, look, I've done that for my daughter. She has an ISA where we put money in, and you can put your gifts in from your grandparents and things like that to top that amount up. Better than the credit union in terms of returns. And it means then that, you know, by the time they're 18, there'll be a certain sum there. And if you teach them about money well, then they'll be able to use that money for, you know, something later on in life. And I've clicked on this and I can't see anything now, excuse me. Yep. Talking, Scott Gardner then, talking in terms of first time buyers saving up for a house deposit, is investing better short term with the dual income household, or should you start investing? Yeah, okay, good question, Scott. What I would say is a mortgage deposit is a near term goal within 5 years. So if you were saving to get married, you're saving for a home deposit and all the rest, that would be a near term goal. And in that instance, I would probably advise you not to invest that money. I would set up a sinking fund, which is what it's called, and I only heard that term a few months back. So I was like, somebody who talks about money all the time, I only heard about that recently. But a sinking fund is a bank account, and it's a pot. So if you have Monzo or starting, you have a Monzo pot, and you put your money in there rather than investing. Because if you invest your money and the market dips 20 or 30%, because it does happen over that 5-year period, you may then not have enough money for your deposit. So I would be more stable or secure with that money and save it in that short-term period. Get as much income as you can through the oh my goodness, instant access savings account with a high interest rate. I nearly forgot what I was talking about there. And Monzo have a steady 4.5% today, or if you lock that money in for 12 months, you can get over 5%. So it's well worth doing that with that money, because you will need it very shortly, and you just keep topping that up. And you can put money into a joint account and save in a joint savings account, or you can do it individually and pull your money together at that later stage. Would you have any advice on transferring a poorly performing pension pot from a previous job? No, I'm sorry, Denver. I don't have any knowledge on that, and I don't know if it's one of those questions that I'm able to answer. I'll steer clear of that one. I'll go and research it for you though, because I know we were chatting on email, so I'll do my best to research that. You might be able to pull the money out and put it into a SIP. I don't know. You might be able to bring it out and into your other pension accounts, but certainly it's not something that I personally have done or have knowledge of, so I do apologize. Any other questions? No? Great question, Johnny. Actually, before I finish then, that I did not know about Vanguard. In fact, Vanguard didn't have any funds here when I started investing. That was the reason why I didn't. So I had accounts with other providers before Vanguard were in the market. More recently, I have used Vanguard exclusively myself. Vanguard overall are very good. They don't have the lowest fees in the market, especially for holding your money and your investments. So some people use other accounts like Interactive Investor who have smaller fees, generally speaking, but it's completely up to yourself. Your money in those accounts isn't like a bank account where, you know, it's protected up to 85,000. You have bought stocks and shares to the value of the amount of stocks and shares you've bought. So there's no protection like that because you own the companies rather than the money sitting in accounts. But the 85k, up to 85k, if you did have money in the accounts, would be protected as well. Okay, right. If that's okay with everybody, I'm going to thank you all for joining me tonight, and I'm going to leave it there. I really appreciate you all joining me, and if you have any questions like here, guys, hit me up on Instagram, send me a message, an email. You'll get me on LinkedIn most days. I know a few of you guys talk to me on there as well. I really appreciate you joining me tonight, and I hope it has been as worthwhile for you as it was for me. Have a great night, guys, and thank you all. Bye-bye.